there's things that the market already kind of knows or sniffs out and things that are total surprises. Your view is it's going to be a tough week, but tougher than expectations?
Tougher than expectations. When we talk about the things that I think will surprise to the downside, I'm thinking that some of this data from the housing market will be rather surprising in terms of broad-based consensus. Remember, we get the National Home Price Index. I think the June residential home sales data, all that will reveal, I think, more deterioration than folks were expecting. And remember, this is a key contributor to the economy, right? 2/3 is consumer spending, and rising home prices and the ability to access that equity cheaply has been a source of funds over the last 2 years, and that will turn. I think the other surprise will be the 100 basis points we're going to get on Wednesday. I think the market's firmly pricing in 75, as your last conversation probably uncovered. And lastly, I think that when we get the GDP numbers, that'll be a surprise as well. Consensus has been at about 1.6% growth. I'm forecasting 2% contraction, which will mark the second quarter in a row that we've had contraction, which by some definitions, by some measures, means that we are firmly in the beginning of a recession.
Then why wouldn't that give the Fed some leeway to consider waiting on the next one, do 75 now? We already have 2 negative quarters. Why? You know how warped the market, how a lot of participants are. If that gives the Fed cover to maybe not go as far as we were thinking, that could be taken positively.
Right. I don't think it does that. I think that the Fed probably has a longer-term view than we do, and this is the slowing of the economy is a pain that is unavoidable if we want to have price inflation correct. And so I think at this point, the Fed foresees that that this is, having not started this program last year, as many of us had asked, that they're so far behind the curve that at this point, something of that magnitude is necessary. I do not think that the economic data is weak enough yet for the Fed to lift its foot off the gas. And quite frankly, I don't know if a full point is all that Herculean. The Fed's done that 38 times since 1970. And so, we act like it's a catastrophic move. And I think just to put it in broader context, this won't be the first time.
Do we then, or in your view, this nice start we've had to July, given this horrific year that we're in, this eventually rolls over, heads back close to the lows, goes below 3650 on the S&P. What is? I know that's being very, I'm asking you for. I don't care when you tell me it's going to happen. I won't ask you for duration, but even direction is tough enough. What do you think?
I think we do test further lows. At the end of the day, what we need to happen is to have a shared view of reality, I think. And at this point, we still have analysts projecting double-digit GDP growth in the back of the year. There are those of us on the other side who don't foresee that as a realistic scenario. You'll recall, Joe, back in January when I said fair value was 3,800 and others were saying 5,000, we just didn't have a common view of the neighborhood we were in and where we're going. I think more of that needs to happen. While we've been in the midst of a pretty aggressive earnings revision to the downside cycle, there's still more to come. As you and the previous guests were talking about, we're still getting surprises. We're still getting surprises in technology, that ad spend is softer than we encountered. Even on large-scale technology, that the strong dollar is having an impact. So until we stop getting these surprises, until estimates get to where they need to be, until we're on the same page with where interest rates need to be and 100 basis points is no longer a great surprise, until we're in that environment, we can't really talk about what valuation is because we don't have common expectations for the future. And so I do expect that we'll test new lows. I expect that we'll exit this year probably with inflation still north of 5%, which implies aggressive Fed action throughout the year. And I don't think the market is pricing that in.